Today, we're exploring a topic tied to our recent videos on dividends and taxes, high-yield dividends and risks. High yields can be tempting, but they come with pitfalls. We'll break it down with examples to help you invest wisely. Let's jump in. High-yield dividend stocks, those offering yields above 5%, are like sirens luring investors with promises of big income. Companies like AT&T or Altria often boast yields of 6 to 8%, far above the S&P 500's 1.3% average in 2025. For a $100,000 investment, a 7% yield from Verizon delivers $7,000 annually versus $1,300 from an index fund. That's appealing, especially for retirees or income-focused investors. High yields can also cushion volatility. During the 2020 market crash, ExxonMobil's 7% yield provided steady cash flow while stock prices wobbled. But here's the catch: high yields often signal danger. A soaring yield can reflect a plunging stock price, not generous payouts. Take AT&T in 2021, its 7% yield looked juicy, but a bloated payout ratio, over 100%, and heavy debt led to a dividend cut in 2022, tanking the stock further. The payout ratio, dividends divided by earnings, is your first red flag. A ratio above 80%, like Kinder Morgan's 90% in 2015, screams unsustainability. Compare that to Procter & Gamble, with a 2.4% yield and a 50% payout ratio, a dividend aristocrat built for longevity. Another risk? Sector concentration. High yields often cluster in cyclical or troubled sectors like energy, telecom, or REITs. BP, yielding 6% in 2025, faces oil price swings, while REITs like Annaly Capital, with a 13% yield, are sensitive to interest rate hikes. In 2022, rising rates crushed REIT valuations, slashing income for yield chasers. Diversification is key. Overloading on high-yield names invites trouble. Then there's the value trap. Stocks like Macy's, with an 8% yield in 2023, lured investors, only to plummet as retail struggled. High yields can mask declining fundamentals. Always check revenue growth and debt levels. Data shows high-yield stocks underperformed the S&P 500 by 2% annually from 2010 to 2020 when dividends were cut. So, how do you navigate high yields? Smart investors focus on quality. They seek companies with strong balance sheets and moderate payout ratios, like Johnson & Johnson. They screen for dividend aristocrats or kings, firms raising dividends for 25 plus or 50 plus years. If chasing yield, they cap exposure at 10 to 15% of portfolio and diversify across sectors. For example, most smart investors pair Chevron's 4.5% yield with Microsoft's 0.8% for stability and growth. They use ETFs like the Schwab US Dividend Equity ETF for broad exposure with a 3.5% yield. High yields can boost income, but don't ignore risks. Scrutinize fundamentals, stay diversified, and prioritize sustainability. That's the high-yield dividend breakdown. Chase income smartly, and your portfolio will thank you. Thanks for tuning in. Like, share, and subscribe. Hit the bell to stay ahead. Until next time, invest with discipline.